Every fall, you pick a health plan at work. Your employer quietly pays most of the bill, thousands of dollars a year, and you barely think about it. But stop and ask the strange question underneath it. Why is your health insurance your job's responsibility at all? Your employer doesn't buy your car insurance or your groceries or pay your rent. Almost no other wealthy country ties your medical coverage to who you happen to work for. The United States does. And the reason isn't some grand plan. It's a wartime accident that turned into one of the biggest tax breaks in America. And, as economists will show us, one you quietly help pay for yourself. Here's how unusual it is. Your coverage is attached to your employer, not to you as a citizen. Change jobs or lose one, and the insurance can disappear with the paycheck. Your employer, not you, chooses the menu of plans you get to pick from. And this is the main way working-age Americans get covered, while almost every other rich country covers people through the government or a system that follows them regardless of employer. So how did the most personal thing in your life, your health, get welded to your job? For that, we go back to World War II. So let's answer it like an operator. Why does your employer pay for your health insurance? The story runs through a frozen wartime labor market, a quiet tax ruling, and an economic sleight of hand that makes it look like your boss is paying when the money is really yours. One note before we start, this is history and economics, not financial advice. Let's rewind to 1942. It's the middle of the war. Factories are desperate for workers, but the government has frozen wages to stop runaway inflation. An employer who wants to lure a scarce worker legally cannot offer a bigger paycheck, so they reach for a loophole. Here's the chain, and notice that no one ever sat down and designed it. In 1942, the wage freeze specifically exempted insurance and pension benefits. So employers who couldn't raise wages started offering health coverage to compete for workers. Then, in 1943, the tax authorities ruled that the money an employer spent on your health premiums wasn't taxable income to you. And in 1954, Congress wrote the treatment permanently into the tax code. A temporary wartime workaround became the tax-favored backbone of American health insurance by accident. Now the part that makes it so sticky. When your employer pays your health premium, that money escapes not one but two taxes: federal income tax and payroll tax. Compare that to a raise. If your boss hands you an extra $100 in wages, the government taxes it twice. Hand you $100 of health insurance instead, and it's taxed at neither. That single asymmetry quietly pushes your total pay toward ever bigger benefits. Because a dollar of insurance is worth more than a dollar of salary, and the richer the plan, the bigger the tax break. Add it all up across the whole country, and this exclusion is the single biggest tax break in the entire federal code. Counting both the income and payroll taxes it dodges, the government gives up somewhere around $300 billion a year for it. To be precise, estimates vary by who's counting. The income tax portion alone is scored anywhere from $190 to $250 billion. But by the broadest measure, no other deduction or credit is larger. It is the most expensive line in the tax code, and almost nobody has ever voted on it directly. And it worked in the sense that it spread. Today, about 165 million Americans, roughly 60% of everyone under 65, get their health coverage through an employer. It is by far the largest single way the country insures its working-age people. A benefit born to dodge a wage freeze now sits at the center of most Americans' lives. So what does it actually cost? And who really pays? In 2025, the average job-based family health plan cost almost $27,000 a year. Your employer appears to pay the lion's share, around $20,000 of it, and takes about $7,000 out of your paycheck for the rest, $20,000 a year, handed over on your behalf. It feels like a gift from your employer. Here's the twist economists want you to understand. It isn't a gift. It's your money. To an economist, an employer doesn't think about wages and benefits as separate pots. They think about total compensation, the whole cost of employing you. Across the workforce, a dollar the company spends on premiums is a dollar that isn't in the wage pool. So when premiums rise, economists find the money tends to come not out of company profits, but out of workers' future raises. That's a big reason wages can feel stuck even in good years. On average, a growing slice of total pay is quietly redirected into health coverage before anyone sees it. The employer share behaves in the aggregate like deferred wages. This isn't just theory. In a landmark study, the economist Jonathan Gruber looked at what happened when the government forced employers to cover a specific health benefit. If companies really absorbed those costs, workers' wages should have held steady. Instead, wages fell by almost exactly the cost of the benefit. The study found essentially 100% of it was passed through to the workers. The firm didn't eat the cost. The employees did, in the form of smaller paychecks. When your employer pays for your insurance, that is, on average, deferred wages, you trade it away without a negotiation. There's a second catch, and it runs backwards from how you'd want a subsidy to work. Because the tax break works by shielding income from taxes, it's worth more the higher your tax bracket. Counting both income and payroll taxes on the same $1,000 premium, a higher earner saves around $347, while a lower earner saves only about $250. And someone who earns too little to owe income tax still saves on the payroll side, but gets nothing from the income tax break, the piece that's worth the most. By one estimate, about 60% of the whole benefit flows to the top 40% of earning households. It's a subsidy that gives the most to the people who need it least. And tying insurance to a job has a cost that never shows up on a bill. It traps people in place. Economists call it job lock. The classic study found that workers who'd lose their coverage were about 25% less likely to change jobs. The quit rate dropped from 16% to 12%. People stay in roles they'd otherwise leave, delay starting a business, or hang on until Medicare kicks in at 65, all to keep the insurance. One caution, that study is from the 1990s, before the Affordable Care Act made it easier to get covered on your own. So job lock is probably softer today, but the pull is still real. There's one more layer that connects straight back to how insurers work. Most covered workers, about 2/3 and 80% at large companies, aren't actually in an insurance product at all. Their employer self-funds. The company pays the medical claims out of its own money and just rents an insurance company's network and paperwork to run it. Those self-funded plans are governed by a federal law called ERISA, which lets them sidestep most state insurance regulation. It's why a big employer's plan can look identical in all 50 states. And why so much of your coverage is really being run by your employer, not the insurer whose name is on the card. Step back to the widest view. The United States spends about 18% of its entire economy on healthcare, nearly double what comparable wealthy countries spend, and it's the only one of them without universal coverage. Those other countries looked at the same problem and mostly did not tie insurance to your employer. America's employer system isn't the sole reason costs are so high, but it's woven through the whole machine: the hidden tax subsidy, the pressure toward richer plans, the job lock, the self-funding. A wartime accident became a defining feature of the most expensive health system on Earth. If this subsidy is so lopsided, why not cap it? We tried. The Affordable Care Act created a tax on the most expensive employer plans, nicknamed the Cadillac tax, designed to rein in the open-ended break from the top. But it was so unpopular with employers and unions alike that Congress delayed it again, and then repealed it in 2019, before it ever collected a single dollar. That's the tell. This accidental system is now so deeply wired into how 165 million people get covered that even a modest trim proved politically radioactive. So put it together. Your employer pays for your health insurance because of a wage freeze 80 years ago, locked in by a tax ruling that makes benefits cheaper than raises. That break is one of the most expensive items in the entire tax code. It flows mostly to higher earners. And, despite feeling like your employer's generosity, economists find its cost is largely borne, on average, in workers' own wages. It ties your coverage to your job, and it's now so entrenched that the one serious attempt to trim it was killed on arrival. None of it was designed. It's an accident that hardened into the system you live inside. So the next time open enrollment rolls around, you'll see it clearly. Your employer isn't handing you insurance out of pure kindness. Economists find you're largely paying for it yourself, through wages that quietly never made it into your paycheck, all inside a system a wartime accident built. Next time we switch gears and go inside a business you've watched pop up on every corner, the urgent care clinic, and run its numbers like an operator. Can you actually make money opening one? For more on how the system really works, visit shanewelter.com. I'll see you in the next one.